Hi, this is Barry Brooksby. It's important that when you implement a whole life policy using the infinite banking strategy, that it is structured properly. Well, what do I mean by that? Every whole life policy out there has what's called base premium. And base premium is the minimum amount of premium that it takes to keep a policy in force. The problem is that if you only fund a policy with base premium, these policies are less efficient, meaning the cash value doesn't grow as rapidly, the rate of return is lower, and this is how typical life insurance agents set these up, is just with base premium only. So let's say you were going to allocate $2,000 a month or $24,000 a year, they would typically put all of that money straight into base premium. So you're probably buying a lot more death benefit and your cash value isn't going to grow that rapidly. What we do is we use a special supercharged rider called paid up additions. And paid up additions acts like an accelerator. It's going to increase the cash value, it's going to increase the rate of return, and by using paid up additions, we're going to get maximum efficiency. Again, increased cash value, increased rate of return, and the death benefit will also increase. Which again, the death benefit is an asset to you. The day you implement it, and it will become more and more of an asset to you later in life. So rather than $24,000 going all into base premium, we're going to take a portion of that and put it into paid up additions. For concept today, I'm just going to look at like a 50-50 split, where we would only take $12,000 and go into base, and take the other $12,000 into paid up additions. We don't know for sure until we get an offer back specifically for you from a life insurance company, how long you want to fund it, how long you might be working. There are other factors that come into play here. But conceptually speaking, the policies we structure with infinite banking all have paid up additions because it is an accelerator for your cash value, which means you have more cash value to use for policy loans, for businesses, for real estate, for equipment, for cars, whatever you want to use it for. At the very top of this, the maximum funding of a policy is the MEC limit. The MEC limit is the modified endowment contract limit the IRS sets that says, based on your death benefit, this is the maximum amount of money that you can put into the policy. Now, if you want to put more money than $24,000 into the policy and you don't want it to MEC, we very simply raise the death benefit to allow that. But the goal is to not go over the MEC limit. That's the maximum amount that can be put into a policy based on the death benefit. If we want to keep the base death benefit the same, but we still want to increase the MEC limit, we may add a term rider to this. So it's possible to add a term rider to the actual policy, to the actual whole life policy, that raises the MEC limit, so you're still keeping the base a low number to maximize even more paid up additions. Again, depending on your situation, you may or may not need that in the policy. As you're looking at implementing an infinite banking policy, you want to be sure that it's structured properly from the beginning. Then we continue to assist you how to utilize it throughout your life. We only use whole life insurance because the cost for insurance in a whole life policy, it never goes up. It doesn't matter if you're 40, 60, 80, or 100. Once you start a policy, those insurance costs will never go up. That isn't true with universal life or indexed universal life or variable universal life. We only use whole life because of the guarantees and the costs never increase. Be sure when you structure your infinite banking policy that it's done correctly, that it has paid up additions, and that you learn how to use it throughout your life. To learn more about infinite banking, please visit wealthoptimized.com.